So we all know that the real estate market has had a massive boom for the last couple of years, but recently a little bit of turmoil, a lot of people talking about it, and some cracks forming for this whole market that maybe we start to see it come tumbling down. And the first massive problem pointing out to this is just the payments. Payments for housing or mortgages has gone through the roof, absolutely skyrocketing to the highest levels it's ever seen because interest rates have gone up quite a bit. Where before you might be able to lock in a rate around 2-3%, now it's 5% plus, and that percentage plus the housing prices have not come down means your payment is massive compared to the house you could have got just a couple of years ago. The exact same house in 2020, if you bought one that you bought now, the exact same house, the payments could be drastically different strictly because the interest rate is just so much bigger now. And we can really see this problem arise in the price to income category, where you can see the charts just kind of off the chart. We see it much higher than even it was during the 2006, 2007, close to the financial crisis. And when that was at the peak, we know what happened next. And now we are above those levels. Housing prices have gone up so much, and wages are just not following, where the average wage, hourly wage, is $27, and the cost of a house would be around 16,000 times your hourly pay. It would take you 16,000 hours to pay for the house, and those levels are higher than the great financial crisis, and we all know what happened next after that. So maybe we're starting to see warning signs of that it's not sustainable at these levels, and that maybe housing prices are going to start coming down. And if we want to look at a chart here to kind of show how much these interest rates can impact you buying a house for the exact same price, you can see right here, this price, if you have a $500,000 house and you have $250,000 in equity, so that means your mortgage is $250,000. So at a 3% rate, it's just over $1,000 per month for a mortgage, 30-year mortgage. If you'd buy the same exact house with the same thing at 5.5%, which is kind of where the rates are at now, your payment goes up almost $400 a month. For the exact same house you already had, a $500,000 house, your payment went up $400 to not really get anything more, strictly because the interest rates went up. And you can see that it just continues to drastically affect your payments. So even if you want a $600,000 house, so say you are selling a house and you were going to move into a better house, maybe more bedrooms, more bathrooms, more square foot, more something, and it's $100,000 value more, and you have the exact same thing with 250,000 down to put in the house for your equity, $350,000 mortgage at 5.5% is going to increase your payment by almost $1,000 a month. So is it really worth it to be buying a new house or trying to move up and buy a house with more rooms or bathrooms or bigger house for $1,000 a month? And it's not going to be that drastic. Are you willing to pay an extra $1,000 a month to have an extra bedroom? Not many people are probably willing to do that. So right now, the big question is, are there people willing to sell to move up and move into a bigger house or move into a house with more rooms or something extra? Right now, not many people will be willing to do that, because who is going to pay $1,000 a month extra for one room? And if you want to tie this a bit into the stock market and say maybe stocks can be a leading indicator and show us what's going to happen in the future before it happens, we could look at stocks that are dedicated to the real estate market, things like Zillow and Redfin. And if you look at these stocks, they have not had such a great return. They've been plummeting and plunging lower and lower, which maybe that's a front runner to kind of say, because these companies, and Zillow, Redfin are leading companies in this industry, aren't doing very well, then maybe the entire industry as a whole, the backbone of it, which is the housing market, isn't going in the right direction. And if it hasn't fallen yet, which it really hasn't moved too much, then maybe a tumble down is about to happen. And those warning signs are there with the stocks falling the way that they are, and even buyers not willing to buy new homes. The new single family home sales are plummeting. They are extremely low. And if we look at this chart, we can see that basically every time that we have this plunge down, it leads to a recession. Every time it plunges, we get a recession. So is this one different or more of the same? Probably going to be more of the same. We're probably leading indicator. I mean, we already know we're in a recession. We've had the two negative GDP quarters. No matter how many people want to say that doesn't classify a recession, it does. So we know we're already in a recession. How much deeper can the recession get? How much worse can it get? That's unknown. But for now, we have these leading indicators of the real estate market, which is a big, obviously, backbone of the economy. When the economy is doing really good, the real estate market's doing really good. When the economy is doing really bad, the real estate market tends to do really bad alongside with it. And real estate has ties to the greater economy with things with construction. And obviously, we know that is a backbone of the economy. So if there's no real want in the real estate market for housing and people can't afford the housing and especially new housing, then construction slows down, and construction slows down. That spirals into other jobs, and it just has a massive effect on the economy. It's a good way to kind of see where things are going. And right now, we know that the economy not in the greatest spot, not very strong. So that could easily lead to the real estate market getting weaker, which we've already seen happening and signs of getting worse, that it might be time for the real estate market to take a tumble. And with housing affordability at its lowest since the great financial crisis, we could see that all these warning signs are here. Everything is screaming that there are problems coming ahead. But is the government or the Federal Reserve going to bail everything out like they did before? At some point, I think they might have to, but there could be some pain leading up to that point. But to end this off on maybe a little bit more of a positive note, there is one thing at least that I've seen that is looking better, and that's the delinquency rate. It's on the decline, meaning people are making their payments, and they're not, missing payments or going foreclosure, doing all this stuff. They can actually afford the houses they have. But the bigger question is, can they afford new houses or to move up or to join the market and buy houses? Because ultimately, that's what the market is. With houses selling to buyers, if you don't have any buyers, then the value of that house goes down until someone can buy it. The value of any asset is only worth what someone's willing to pay for it. Like if you have $100,000 house and you bought it for 100,000 and that's what it was worth, but when you go to sell it, there's only people willing to pay 80,000 for it, then it's worth 80,000. It's only worth what someone's willing to buy it. Any asset, stocks, crypto, housing, all of those, they're only worth what someone is willing to buy it. Stocks and crypto, super liquid market, constantly trading, constant buyers and sellers, a lot easier to get that price. Real estate, not very liquid, very long process, so it's much slower moving than these types of markets. And it's harder to kind of know your exact value because every house is different. Every house has something else that maybe someone values more or values less. So it's tough to price that in. But at the end of the day, your house, your asset is only worth what someone else is willing to buy for it. If there's not enough buyers willing to buy, then you might run into problems with prices needing to come down. So, a lot of warning signs in this real estate market, a lot of problems arising, maybe a little bit of hope in that delinquency rate, but ultimately, a lot of things saying that the market, the housing market, might be in some trouble and we might see some pain ahead in the market, which, if you own real estate, might be a bad thing. And if you want to buy it, maybe it's a good thing and you want to see prices come lower to buy some house. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And see you guys in my next